the factor that most moves mortgage rates is inflation. And inflation peaked and has been coming down. It hasn't been coming down to the Fed's target of 2%, but we believe that we'll continue to see in 2025 lower levels of inflation. One, for the job data that we just showed you, we just talked about, but also because right now the inflation numbers are a bit inflated. And here's what we mean. And there's a couple different ways to measure inflation. Don't get caught up in that. We're going to look at core PCE and we're going to look at core CPI. Just two different ways to measure inflation. Let's not overcomplicate it. So as of September 2024, core PCE was 2.65%, but 18% of the weighting of that inflation, that core PCE inflation measurement, is shelter costs. And because of the way that the shelter costs are calculated, which is in the rear view mirror, looking backwards over the previous 12 months. And remember, you may have signed a lease in 2022 that extended into 2023 and becomes now part of this backward looking measurement of inflation and the increase of shelter costs. 18% of the core is shelter costs. And the way that the government is calculating this number, they're showing 5.1% year over year shelter cost inflation. But if you look at it in real time, based on the CoreLogic rent index, there was really only 2% year over year inflation. So this is a backward looking inflation measurement. Once it catches up to the real time rent inflation, we're starting to see that slow down. We believe that will drag inflation lower. And as inflation goes lower, so will mortgage rates.